What is growth investing? Growth investing is an investment strategy that focuses on companies expected to grow at an above average rate compared to other companies in the market. Unlike other investment approaches, growth investors seek businesses with strong potential for expansion, where growth significantly outpaces the market average. Unlike value investing, which looks for undervalued companies, growth investors seek businesses with strong future potential, even if current valuations seem high. Growth investors are willing to pay premium prices for shares because they believe in the company's future potential. These investors believe the company's future performance will justify the investment as earnings and revenues increase substantially over time. In summary, growth investing concentrates on companies with strong future potential, where substantial growth in earnings and revenue can justify higher initial valuations. Growth stocks are characterized by above average revenue and earnings growth rates compared to the broader market. Growth stocks typically operate in expanding industries or markets with high growth potential, such as technology, healthcare, and emerging sectors. Unlike value stocks that often pay dividends, growth companies typically reinvest their profits back into the business to fuel expansion, research, and development. Growth stocks typically have high price-to-earnings ratios because investors are willing to pay a premium for their future earnings potential, often trading at multiples well above the market average. Growth companies are typically developing innovative products or services that disrupt traditional industries. They often lead in technological advancement and market transformation. Growth stocks can be found across various sectors. Technology companies like NVIDIA, healthcare innovators like Moderna, and consumer disruptors like Amazon are all examples of growth stocks that demonstrate these key characteristics. To summarize, growth stocks exhibit above-average growth, operate in expanding industries, reinvest profits, have high PE ratios, and focus on innovation. Understanding these characteristics can help investors identify potential growth opportunities in the market. Growth and value investing represent two fundamental but distinct approaches to stock selection. Growth investors focus on companies with high growth potential, often regardless of current valuation. Value investors, on the other hand, seek undervalued companies trading below their intrinsic worth. Growth stocks typically have higher price-to-earnings ratios and offer lower or no dividend yields. Value stocks often have lower PE ratios and higher dividend yields, providing income to investors. Growth companies are expected to grow earnings at an above-average rate, commonly in sectors like technology and biotech. Value investments are often found in more established sectors like financials and utilities, trading below what investors consider their true worth. Both growth and value investing strategies can be successful, but they tend to outperform each other during different economic cycles. Growth stocks often outperform during bull markets and economic expansions, when investors are optimistic and willing to pay premium prices for future growth. Value stocks tend to be more resilient during economic downturns and recessions as their lower valuations provide a margin of safety. During recovery phases, growth stocks often lead the market as investors anticipate future earnings improvements. In periods of uncertainty, investor preference can shift between growth and value, creating opportunities in both strategies. Let's compare the key metrics that differentiate growth and value stocks. Price-to-earnings ratios for growth stocks are typically much higher, often above 30, reflecting expectations of future earnings growth. Value stocks usually offer higher dividend yields, providing income while investors wait for price appreciation. Growth companies trade at higher price-to-book ratios, while value stocks often trade near their book value. Revenue growth rates are a key differentiator, with growth stocks showing rapid expansion compared to the steady performance of value stocks. Finally, market perception differs significantly. Growth stocks often attract momentum investors, while value stocks may be overlooked despite solid fundamentals. To summarize the key differences between growth and value investing, both strategies can be successful, but they tend to outperform in different market conditions. Growth investing targets companies with strong future potential, accepting premium prices today. Value investing seeks currently undervalued companies, providing a margin of safety. Many successful investors blend both approaches, adapting to changing market conditions. When choosing between these strategies, consider your investment timeline and personal risk tolerance. To evaluate growth potential, investors analyze several key metrics and qualitative factors. Quantitative metrics include historical and projected earnings growth rates, revenue growth trends, return on equity, profit margins, and market share gains. When comparing earnings growth, investors look for consistent upward trends over time. Companies with accelerating growth rates are particularly attractive. Return on equity, or ROE, measures how efficiently a company generates profits from shareholders' equity. Growth investors look for companies with higher ROE than industry averages, like Company A shown here. Qualitative factors are equally important. These include understanding the business model, competitive advantages or moats, management quality, total addressable market, and future growth catalysts. Total addressable market, or TAM, is a critical factor in evaluating growth potential. Companies with a large TAM and small current market share have significant room for expansion. Sustainable competitive advantages, often called economic moats, protect a company from competitors. These include network effects, proprietary technology, brand strength, scale economies, and high switching costs. To summarize, evaluating growth potential requires analyzing both quantitative metrics and qualitative factors. The most promising growth stocks demonstrate consistent earnings and revenue growth, strong ROE, large market opportunities, and sustainable competitive advantages. Growth investors employ various strategies to build their portfolios. Let's explore 5 key investment approaches used by growth investors. Established growth investing focuses on large or mid-cap companies with proven track records. These market leaders offer consistent earnings growth with relative stability compared to riskier options. Emerging growth investing targets smaller companies with innovative, disruptive potential. While offering higher growth prospects, these investments typically come with increased volatility and risk. GARP, or growth at a reasonable price, seeks to balance growth potential with sensible valuations. Investors often use metrics like the PEG ratio to find stocks with attractive growth prospects that aren't excessively overvalued. Momentum growth investing targets companies showing strong price and earnings acceleration. This strategy often employs technical analysis to identify stocks outperforming the market, with investors frequently adjusting positions. Thematic growth investing involves identifying major economic, technological, or social trends and investing in companies positioned to benefit from these developments. This approach often takes a long-term view across diversified but related investments. Let's compare these 5 investment strategies across risk level, growth potential, and typical investment horizon. Each strategy offers a different approach to capturing growth opportunities. Investors often combine multiple approaches based on their financial goals and risk tolerance. Risk management is essential when investing in growth stocks. Growth stocks typically exhibit higher volatility than the broader market. They can experience sharp corrections when they miss earnings expectations or when their growth slows. Let's explore effective strategies to manage these risks. First, diversify your growth investments across different sectors and company sizes. Second, establish position size limits. Avoid overconcentration by limiting any single position to no more than 15 to 20% of your portfolio. Third, consider dollar cost averaging when building positions in growth stocks. By investing fixed amounts at regular intervals, you reduce timing risk and potentially lower your average cost. Fourth, set price targets and stop-loss levels for your growth investments. Stop-loss orders help limit your downside risk and remove emotion from selling decisions. Typically, set stop-losses at 15 to 20% below your purchase price. To summarize, Effective risk management in growth investing requires diversification, avoiding overconcentration, establishing position limits, dollar cost averaging, and setting clear price targets and stop loss levels. While growth investing carries higher risks, these strategies can help you capture the upside while protecting your portfolio from significant losses. Growth stocks typically excel in specific market environments. During periods of economic expansion, these stocks tend to outperform the broader market. Low interest rate environments particularly benefit growth companies as their future earnings are discounted at a lower rate, increasing their present value. Periods of technological innovation create tailwinds for many growth-oriented companies, especially those at the forefront of emerging technologies. Conversely, growth stocks often face headwinds in challenging market conditions. During economic downturns, investors typically become more risk-averse and prefer stable cash flows over future growth potential. High inflation environments erode the value of future earnings, which disproportionately impacts growth stocks that are valued based on earnings expected years into the future. Similarly, rising interest rates increase the discount rate applied to future cash flows, lowering the present value of growth companies' expected earnings. Growth stock performance follows cyclical patterns aligned with the broader economic cycle. Understanding these patterns can help investors time their growth allocations. Interest rates have a significant impact on growth stock valuations. Lower rates create a favorable environment for growth investing, while higher rates typically compress valuation multiples. Savvy investors adjust their growth exposure based on prevailing market conditions. During favorable environments, overweighting growth stocks can enhance returns. As conditions shift with rising rates and inflation, reducing growth exposure to a neutral position can help protect against valuation compression. During recessionary periods with high interest rates, underweighting growth stocks in favor of more defensive investments typically preserves capital and positions investors to re-enter at more attractive valuations. By recognizing these cyclical patterns and adjusting accordingly, investors can optimize their growth exposure across different market environments. Let's examine 3 renowned investors who have built their reputations on growth investing. Philip Fisher, often called the father of growth investing, pioneered fundamental growth investing in the 1950s and 60s. Fisher's book, Common Stocks and Uncommon Profits, remains influential today. He emphasized long-term investment in companies with superior management and innovation potential. His approach focused on finding companies with exceptional management quality, strong innovation capabilities, and consistent growth in both sales and profit margins. Moving forward in time, Peter Lynch managed Fidelity's Magellan Fund from 1977 to 1990, delivering remarkable results. Under Lynch's management, the Magellan Fund achieved an impressive 29.2% average annual return, significantly outperforming the market. Lynch advocated for investing in companies with understandable business models and strong growth prospects. His famous advice was to buy what you know, suggesting retail investors leverage their everyday knowledge. In the modern era, Cathie Wood of ARK Invest represents a contemporary approach to growth investing, focusing on disruptive innovation. Since founding ARK Invest in 2014, Wood has become known for her high-conviction bets on innovative technologies and disruptive companies. Her investment approach focuses on disruptive innovation across 5 key sectors: genomic revolution, artificial intelligence, financial technology, next-generation internet, and autonomous technology. These 3 growth investors, while operating in different eras, share common principles, focusing on innovation, prioritizing long-term growth, and developing a deep understanding of their investment targets. Growth ETFs and mutual funds provide a convenient way to invest in growth companies without selecting individual stocks. Popular growth ETFs include the Vanguard Growth ETF, which focuses on large-cap growth stocks, the iShares Russell 1000 Growth ETF, covering large and mid-cap growth companies, and the Invesco QQQ Trust, which tracks the tech-heavy NASDAQ 100 index. For those who prefer active management, Options include T. Rowe Price Blue Chip Growth Fund, with its focus on established growth companies, Fidelity Contra Fund, which takes a contrarian approach, and American Funds Growth Fund of America, known for seeking growth at reasonable prices. Growth funds offer several advantages over selecting individual stocks. They provide instant diversification across many growth companies, professional management by experienced analysts, lower risk through broad exposure, and save investors valuable time on research. Over the long term, growth-focused funds have historically provided competitive returns, particularly during periods of economic expansion and innovation. While they may experience higher volatility, their long-term trajectory typically outpaces value funds during growth-favorable market conditions. Growth funds are particularly well-suited for several types of investors: those with limited time for individual stock research, newer investors building their market knowledge, investors seeking broad exposure to growth companies, and those with long-term investment horizons who can ride out volatility. To summarize, growth ETFs and mutual funds provide diversified exposure to growth companies, offer professional management that reduces your research burden, lower your risk through broader market exposure, and are suitable for various investor profiles and financial goals. Building a successful growth portfolio requires a disciplined approach and long-term perspective. Start by establishing clear investment goals. Define your target returns, time horizon, and most importantly, your risk tolerance. Develop a systematic process for identifying and evaluating growth opportunities. This includes screening for potential investments, conducting thorough research, proper valuation, making investment decisions, and continuous monitoring. Maintain a well-organized watch list of potential investments. This allows you to track promising companies and monitor your existing holdings regularly for any changes in fundamentals. Be prepared for volatility and avoid emotional reactions to short-term price movements. Growth stocks can experience significant price swings, but the long-term trend is what matters most. Consider combining growth with other investment styles for better portfolio balance. While growth may be your focus, including value, dividend, and international investments can reduce risk and improve returns. Remember that successful growth investing often requires patience as companies execute their expansion plans over multiple years. The most significant returns typically come after several years of holding quality growth companies. Building a successful growth portfolio comes down to having clear goals, a systematic process, active monitoring, emotional discipline, balanced diversification, and above all, patience to let your investments grow.